We just helped a client with this this week, actually. So we're going to get them about $80,000 at 0%, and they're going to take that and they're going to invest that money. Okay. Now, what are we not going to do with that 0%? We are not going to take trips. We are not going to buy plane tickets. We are not going to get a new vehicle. We are not going to buy furniture for the house. We are not going to get a new TV. We don't help broke people get credit. Like, that is one thing I can't iterate enough times. If you have a credit issue, it's because you have a credit issue. You got a problem like with spending money that you don't have and then not earning it back to pay it back. So when you're looking at how do I improve my credit and get 0% lines, we don't actually offer this to clients who are just starting. We're going to help you with this down the road. We're going to help you with this after you've done your sacred account, after you've built your blueprint, after you've gotten all of these things in place that are fundamental. Then we'll go look at credit. Okay, because if you have a credit problem and I give you more credit, as we've talked about, it's like giving drugs to a drug addict. It's not going to help you. It's going to just give you more problems. You're going to dig yourself deeper. Okay, so that's the basics on the credit stuff. We're going to move on to our next segment here. Once we've handled credit for our clients, we do move into three things. We move into legal, we move into estate, and we move into tax protection. Legal, state, and tax protection. Okay, now a couple things here. The first one is the estate itself. Okay, so I grew up in a family where we didn't have much money. So the idea of a will and the idea of an estate plan was kind of just like not even real to me. I never thought about that. When I think the only time I ever saw wills was like in movies. You know, so-and-so inherits all this money and his grandfather had a will, and they take the will out and they read it and it's this old scroll and in pen, and they're like, wow, you've inherited all the money. And the kid's like, you know, rich now. That's what I thought wills were for. Not practical for most people. Like most of us, we don't think that that's going to be us, which is one of the main problems. Okay, so even if you're broke, a will is an intention to become wealthy. If you've established a will, you're saying, I plan on having stuff. I plan on being worth something. I plan on leaving a legacy behind. So if you're single, broke, you own nothing, setting up a will is a step in the direction of ownership. If you don't have a will, why would you own stuff? See, mentally, it's actually an excuse not to have to do the thing you know you need to do and create wealth. I don't have a will, therefore I don't need to go own stuff. See, you're thinking it's the other way around. I don't need a will because I don't own stuff. Really, what's happening is because I don't have a will, I don't need to accumulate. It's an excuse. It's a justification for not building wealth. So here's the deal. Technical on the will. You do need a will. A will is what happens to my possessions if I die. Okay, if I die without a will, it is called intestate, meaning that I died without any sort of estate plan or will. And what happens is my assets now go to the state and they go into probate, and the state has rules and regulations that dictate who my assets are going to go to. Usually they will be my family members or naturally people that I would have inherit my assets. But here's the deal. What if I don't want certain people inheriting certain assets? Or here's the other deal. What if I had, you know, let's say it wasn't even monetary. Let's say it's an heirloom and I want that going to my daughter. And I don't have an estate plan. And because I don't have an estate plan, my son gets it instead. And that really mattered to me, and I'm not alive to do anything about it. So think about, like, what are the things you would do for your family while you're alive? And that's what the will is. You're going to give those things and add that value to your family after you've passed away through your will. Now, here's the other problem. If you don't have a will and it does go to the state and they do start looking at who they're going to distribute it to, they're probably not going to do that for you. They're going to elect one of your family members to do that. And you might be like, oh, that's not a big deal. But here is the big deal. Your family members don't have time to handle your crap. Your family members have jobs. Your family members have responsibilities. So for them to say, I have to take off 2 weeks of work because Jerry died and he doesn't have an estate plan. I've got to distribute all of his assets the way the state said to, and deal with all the bickering between the siblings and the family members and everyone that's involved because nobody got what they thought they would get. Like, you don't want to put that on anybody. Okay, so that's your will. Next component is your living will. Okay, your living will is also important. So your living will is actually not when you're dead. That's why it's called a living will. And it's going to cover what happens to my things if I am incapacitated and I can't make financial decisions. Okay, so let's say that I get hit by a bus, I become a vegetable, and I can't talk and think anymore. Okay, I have to have a living will that elects somebody to make those decisions. I've got to make those decisions on paper ahead of time. And the living will is going to help with that. The last component on your basic estate plan is called a healthcare directive. Okay, your healthcare directive is what happens if, let's say I'm, again, incapacitated in a hospital and I can't make medical decisions. Okay, the hospital is not going to make that call. If there's a big medical decision, they don't want the liability of making that call and then finding out it was the wrong decision. So what's going to happen is if you have an urgent situation going on and you don't have a healthcare directive, that sucks. You just got to sit there. Like they're not going to do stuff for you if you don't have somebody that can legally elect and make those decisions and carry that liability for you. Okay, that actually happened to my mom. So when she was, she had cancer. So when Lexi remembers this, she was in the hospital. They gave her a whole bunch of jungle meds, everything that they could think of, right? They intermixed, side effects like kind of like commingled. And for like 2 days, she was batshit crazy. So we had to take her to the hospital and let her chill out. Now, we couldn't do anything other than just keep her in bed. And even that, they were like, hey, you guys are pushing on keeping somebody against their will in the hospital. Like, that's not something you can just do. Because you don't have a healthcare directive, we can't do anything, we can't help. You know, she can stay here as long as she doesn't demand to leave. If she demands to leave, you guys have to let her leave. And that's pretty much what it was, right? And so that's like, when you think about healthcare directives, these are things that probably aren't going to happen. But if they did, you would not be the person that doesn't have something in place, especially for how inexpensive they are. Okay. Now, as we move through this, the next thing you want to look at, so those are your basis layers of estate planning. After that, once you've got assets, you probably want to look at a trust. Okay, and the reason why is a trust becomes an entity, right? So an entity is like an individual or a corporation. It's got its own tax status with the government. It's treated like a person. So if I die and I don't have a trust, even if I have a will, my stuff still goes to probate. Meaning the government does hang on to it. They don't redistribute it, but they do hang on to it temporarily until it's gone through probate and it gets distributed the way that my will says to. If I have a trust, when I die, I don't own anything. My trust owns it all. Therefore, none of my stuff goes through probate because technically the owning entity of those possessions didn't pass away. I did, but I didn't own any of that stuff. My trust did. Okay, so that can also help with estate taxes. That can help with protecting your assets to make sure that they do go the way that you want them to. And a trust has a trustee, meaning somebody's job is to manage that trust, which is a little different than a will. Your will has an executor. And that executor, you know, they're going to do their best to abide by the will, but the estate plan is actually like a job because they're working for something that's still living. They're working for your legacy, basically, and they've got to carry out the constitution of your estate plan, the documents that say, here's how it's going to go. Okay, so a lot of wealthy people, the way that they play this is they have a trust, they do have a will, they have all that stuff, but all of their assets go to a trust. And they have the conversation ahead of time with their family saying, hey, we're wealthy. When I die, I don't want you squandering the money. So when I pass away, the trust owns all of it. So-and-so is in charge as trustee. And here are the restrictions and guidelines of when you can use this money and what you can use it for. So you literally could say, unless you're buying a real estate deal that does this in cash flow, you are legally not allowed to touch any of the money. And that's what would happen. They couldn't touch any of the money because it would stay in the trust because that's the provisions in the trust. So that's going to be the trust. You can do a revocable living trust. You can do an irrevocable living trust. Again, I'm not an attorney, but I do want to go ahead and recommend, probably if you don't have to, most people while you're still alive don't do irrevocable. Irrevocable means you can't make changes. You can't change beneficiaries. You can't change trustees. So if I'm still living, I would want the flexibility of the revocable living trust because I can actually make updates to it. I can change things. If Billy gets addicted to crack, I can take Billy out as a beneficiary. But if I do irrevocable, like that's going to happen no matter what because it's set in stone now. So it's going to be a lot more flexible for you. Now, you can also do, there's several different trusts. You can do charitable trusts. You can do irrevocable life insurance trust. There's different ways to structure it, but the trust is a advanced step in your estate plan. Okay, and it may not be something you need right now. So if you don't have assets now that you would be trying to avoid having go through probate, you may not need the trust. And that's more of a call you're going to make when you build out your blueprint with us. We're looking at what do you have, and we're looking at, do you need a trust? Is this something that's viable for you right now? And eventually it probably will be, right? So that's your trust. Now, once you've got that done, you do also want to make sure from a legal standpoint, we covered estate planning. You also want to have legal protection. Legal protection, meaning you have an attorney that you can regularly consult with. Now, here's the problem. The going rate for an attorney, and I'll just share my experience with you. A month ago, I was filing a new private placement deal. I called an attorney locally. We played phone tag for probably 3 weeks. And then finally, they left me a voicemail because I just said, hey, guys, I need to know your rates. What do you guys charge to do a private placement? And they said, hey, we'd love to talk to you. And if you call us back, you can schedule a consultation and we'll answer that question for you. And by the way, it costs you $150 to schedule a consultation. So I'm like, it cost me $150 for you to tell me how much it's going to cost to do a private placement? No, I'm not doing that. Okay. The average attorney is about $250 an hour. Okay. So if you don't have something else, which we have something else we offer to our clients, anytime you need something, it's going to be $250 an hour. Anytime you want to talk to someone, it's going to be $150. That's how it works. If you actually want them to do something, you're going to have to put them on a retainer for 5 to 10 grand. And it doesn't even guarantee results. Nano looks disgusted right now. It doesn't even guarantee results. It's just you have the permission to talk to them now. They might help. They might do something. There's no guarantees. So we have, it's a legal protection service that you have unlimited access to an attorney on all business, personal matters. That can be document review. That can be sending out collection letters. That can be an IRS audit. That can be a civil suit. That's what you want to have. And the reason why you want to have it like that is most people are too cheap. I know a guy that brags. He's like, I have this giant attorney firm that I work with. They'll help me with anything. The dude never uses them. The reason why is because they're so expensive. Nobody wants to spend the money to use the attorney. So if you take away the price tag, now it's unlimited. Guess what? People start making more informed decisions. They're not worried about calling the attorney because they have access anytime they want to. Just simple stuff for us. We've had several cases where we used it. Last year, I think Lexi had AT&T. You guys know AT&T, the giant global corporation, pulled her credit without her permission. So we called their attorney. They said, yeah, that's super illegal. Turns out you can't do that. They sent AT&T a cease and desist letter. And Lexi got, what did you get, an email from the president of the company?
Yeah, it's like the president of the company's founder office or something like that. It's like a big,
Yeah, she got like
position.
a head executive sent Lexi an apology email and a free iPad. I mean, that paid for itself. We had our dog got in a fight like 2 years ago. This little black dog off its leash, came up to our dog who was leashed. Our dog's 90 pounds. That dog was 20 pounds. That dog was aggressive. Our dog won. And they were trying to make us pay the vet bill. So we were like, hey, we're not going to pay your vet bill. You need to keep your dog on a leash. So they contacted our apartment, and the apartment started getting involved. And the landlord's like, hey, you guys need to make this right, pay for their vet bill. So we told the attorney about it. They reviewed the Alaska state dog walking laws. Who knew there was such a thing as that? They reviewed the Alaska state dog walking laws and found out we were not in the wrong. So they sent a cease and desist letter to our apartment. Boom, end of story. See, little stuff like that. Like right now, we're not even talking about asset protection. We're talking about freedom. We're talking about a large corporation taking advantage of you because they know you're not going to do anything. You may not be in a position. They know financially they can't afford to do something. I can't tell you how many times we've had legal run-ins where they thought we wouldn't have something and we had something more than they had because we had this program. So having legal protection is big, and it actually helps you run your wealth like a business, guys. You do not want to be a mom and pop shop. Like if you're making decisions that could potentially be illegal or potentially shed liability on you because you're worried about attorney's fees, you're not wealthy. So take that off the table. So that's something we're going to help our clients with. We do include IRS audit protection. Okay, so if our clients get audited, they get protection, they get represented in court, they get consultation from an attorney. Okay, it's not just Googling, what do I do in an audit and watching that movie with Will Ferrell. You actually have like, all right, I can call my attorney and ask them, how do I handle this audit? What do I do? What documents do I give them? Here's a good one. What do I actually even need to tell them? Most people that get audited, they're like, oh, the IRS, I better tell them everything. You call your attorney and they're like, no, you only have to tell them this. Okay, we used to have compliance audits. When I was a broker, they would say, if you ever get audited, you call the legal team right away and you have the legal team speak with the auditors instead. That way you're not even involved. I've had clients when they got audited before working with us, they had to take weeks off from work. Okay, what's an audit? An audit is they call bullshit on your tax return, and they're like, show us every single documentation you have on these write-offs you took. So guess what? If you're trying to win, you have to go pull every single credit card statement or receipt or transaction that you saved and prove to them that that was real and it did happen. And if you can prove it, they're like, okay, cool. We back off. If you can't prove it, guess what? You have what's called back taxes. You have to pay a penalty for deducting stuff you shouldn't have because you couldn't prove it, and then you've got to actually pay the taxes. So imagine how long that would take. They pull a tax return, let's say from 3 years ago, and they're like, show us every single receipt and credit card statement or bank statement that you have from 3 years ago. And you're now taking time off from your business or your job or your wealth creation to go focus on this, which is not paying you anything. So imagine having an attorney. You're like, hey, IRS, I don't have time to talk to you. Can you just talk to my attorney real quick? I'm going to go do this instead. Let me know what the outcome is. Whatever you guys need, I'm here. Just don't talk to me. Talk to my attorney instead. I'm busy. So that's the power of that, okay? So you have audit protection, and then as we get into the next phase, it's actually tax planning as well. So you've got legal planning, you've got estate planning, you've got tax planning. With tax planning, there's a couple key words you need to know. Number one is deduction. Deduction. The way you get deductions is you involve an expense with a business. You involve an expense with the transaction for investing. You involve an expense with marketing. Okay, the best deduction ever is marketing. Okay, did you know, again, this is tax knowledge. Did you know that if I took a client out to lunch as a service, okay, it's a service lunch, and maybe I'm treating them, I can only write off a portion of that lunch. Now, if I take my client out to lunch as marketing, I can write off all of the lunch. So you want to write off the right stuff. You have to understand deduction. So that's part of what we're helping our clients do, is gaining the knowledge on, all right, how do I start, tracking my expenses? How do I start deducting expenses? Okay, so you've got deduction. The next one you have is depreciation. Okay, depreciation meaning something went down in value over time. So if you buy something that's going to go down in value over time and it's associated with your business or it's associated with your investments, depreciation means that you're going to take that future decline in value and you're going to write it off as a loss on your taxes. Okay, you're going to say, hey, I'm buying real estate and I'm going to have to fix stuff and the property is going to get dilapidated and it's going to go down in value over time. Even though it appreciates, I can say it's going to depreciate and I can write that off now. That's a big tax advantage. My vehicle, my BMW, I bought the BMW, okay, which is a tax deduction because the business owns it. So I get a deduction off of what I'm paying on the vehicle, but the vehicle is going to go down in value. So I can also write off the depreciation on my vehicle as well. So depreciation is big. The next one is amortization, which is, maybe taking deductions or payments of income and stretching that over a longer period of time. So for example, let's say you had a giant tax deduction from expenses this year and you didn't want to write all of it off. It was more than you needed. Amortize that. Make those future expenses. You're typically allowed to either put that towards future. I think the window is 5 years. Correct me if I'm wrong on that, anybody? The window is 5 years where I can look forward and say, I'm going to move these expenses forward to a different year. Okay, I'm going to future apply these, right? So amortizing those. Exemption is another one. So again, if you can find ways to be exempt from taxes, that's big. Exempt meaning that in certain areas, I just don't have to pay. So understanding tax law is big. It's not just hiring H&R Block or going on TurboTax. Like, you do need to study this stuff. The tax law was made by the wealthy. So if you think about, they basically built it so that they understood it and they wouldn't have to pay any taxes and everyone else would. So if you can understand it the way they understand it, you can not pay the taxes just like they don't pay the taxes. And then the last thing we look at is the bottom line. Corporations and trusts should always hold your assets. Okay, corporations and trusts should always hold your assets. So that's the big thing. Like, when you do start accumulating wealth, you never want to be the sole proprietor and you're handling the wealth personally. You put it in trusts, you put it in corporations, you put it in these other entities that are going to live on beyond you. Okay, if you think about Rockefeller with his trust, Rockefeller Trust is still running today. still running today. It was started like almost a century ago, and it's still worth millions upon millions of dollars. It still spits off income for that entire family. It still funds public works all over the US. So you want to mimic that model. You want to have that same thing happening for you as well. Now we're going to move into asset protection. Okay, asset protection. Now there's one word that we use for asset protection. That word is bullion. Bullion, Bullion. It's gold and silver. It's a real hard asset. Now I was just having this conversation with Nano today about how there is not a single currency in the history of the world that has survived. Okay, think about how long the world has been around. We can debate that, 2,000 years, trillions of years, whatever the answer is. There has been a lot of people on the world for a long time, and those people have always used some sort of monetary system to transact with one another. And every single one of those monetary systems has failed except one: gold and silver. Okay, gold and silver bullion have always been used for transacting. They have always been around. They've never gone away. They've never lost value. They have intrinsic value. They're exchangeable no matter where you are. Okay, if I go to China, they understand gold. Okay, if I go to China and I've got US dollars, they probably don't want them. They're starting to become countries that do not want US dollars. China and Russia right now, they're exchanging their US treasuries. Guess what they're exchanging them for? Gold. So they owned debt and they invested in the US. They're now getting rid of their investment in the United States and they're buying gold instead. Okay, what does that tell you when our enemies won't even let us be in debt to them? Other countries won't even allow us to borrow money from them or sell our debt to them. They don't want our money. Okay, if they don't want our money, then we should be looking at, do we really want our money? Okay, so a couple things about gold here. Gold and silver, like I said, they're the oldest mediums of exchange. They have intrinsic value. And if you look at the dollar, since 1913, guys, the dollar has declined over 3,000% cumulatively. Just continues going down. So the dollar declines over and over and over and over. That's not going to stop either. Okay, gold and silver, if you look at their pricing right now, silver is undervalued by $570 per ounce. $570 per ounce. Right now it's trading around about $15 an ounce at spot, and it should be trading at $585 an ounce. So think about that. What would happen if you own just a tiny chunk of silver, and the economy started to tank, just like every other economy always has, and suddenly silver realizes its value? And you had $15 an ounce of silver, and maybe you had 100 ounces, and all those ounces just went up to 585. What's 585 times 100 ounces? That's $585,000. You just went from, what is that, like 150 or is that 15K? 150K up to 500K. So $15 an ounce times 100, that's like $150,000, right? It's $1,500.
15 ounces times 100.
Yeah, that's $1,500. So $1,500. Correct me. And then we're looking now at, it went up to $578 per ounce times 100 ounces.
So 100 times 578.
Yeah.
Could be 57,800.
57,800. I had an extra zero in there. So you'd go from $1,500 to $57,000, just like that. Okay. And now gold, same thing with gold. So gold is currently undervalued by about $3,500 an ounce. Okay. So gold is trading right around $1,300, $1,400 an ounce right now. It should be trading around $4,500 an ounce. So think about that difference. Like think about, and it's a real asset. Like paper goes down in value, guys. Like it cracks me up when people are like, no, that could never happen in America. It has happened to every single country in the world. Nobody has ever survived it. Why are we special? And we're doing the same thing as all of those countries did. Like imagine driving down a road knowing that there was a cliff, knowing that it was one way, and if you kept driving, you would go off the cliff, and everyone that's ever driven down that road went off that cliff, and that's the only place you could go, and you're like, no, it's not going to happen to me. I'm special because I have patriotism. That's not how it works. Like it's economics. You're making decisions with money based on how you feel. So when you look at, all right, the dollar goes down in value, I don't want to own dollars. Dollars are liabilities. Bullion actually protects my assets. Okay, one of the wealthier guys that I know, he buys $10,000 to $15,000 a month worth of bullion. Like, he just stacks it up. One of the guys that taught me most of what I know, he buys them and he stores it all in a gun safe. He's got shoe boxes full of bullion. Okay, like when I was 16, I remember helping him carry these crates out of his car. I thought they were bullets. You guys know when you buy ammunition, it comes in those like plastic casings, and it's kind of like a carton of bullets, right? So I thought it was that, because he had a bunch of guns down there, 50 calibers, etc. So I was like, man, we're carrying a lot of bullets down. And these were heavy. Like, I'm talking like, 50 pounds, 100 pounds, and we're lugging them down the stairs. And then we set him down and he opens it up and it's all silver. It was not bullets. It was all silver. And when you look at the wealthy, that's what they're doing. If you study wealthy people, they do buy gold and silver bullion. The middle class, they're like, I don't want to buy that. Like, that's for weird people. That's for doomsday preppers. Okay, did you know if you study King Solomon, he was a trillionaire because of how much gold he had? There has never been a trillionaire before. That guy was a trillionaire. Most of it was in bullion and real estate, and it was just like continuing to grow and go up in value. Okay, so bullion is undervalued, and it's a buy and hold strategy. So I do want to make this clear. When you buy gold and silver, and we're a gold and silver broker, so when you buy gold and silver, it's buy and hold. So you're not trying to trade it and flip it. That's called trading. It's buy and hold. So you get at this price, and you don't care. You're not trying to sell it for a gain. You're keeping it. It's like money insurance. You know that the dollar is crap. It's going to go down in value. It's going to crash, and I will always have this. I will always have this bullion. It's always going to be worth something. And I remember my first order, I think I was 22 years old. 22 years old. And even when you hold it for the first time, 22 years old, I made my first order is like $1,300. I got like a fractional piece of gold and a bunch of silver. And when I picked it up, like I could just like, I could feel it. I was like, this is real money. I had never held real money before. And all my life, I thought if I accumulate enough paper, it would be good. And I finally held bullion. I was like, this is real money. This has value no matter where we go. This is going to always be increasing. It's never going to drop. It's always something. Nobody can take that from me. Okay. And those of you that are like, Jerry's weird, like Jerry's freaking out right now, this doesn't make sense. You're not understanding of how the economy works. The economy and the stock market are not the same thing. Most people think, oh, the stock market's up. The economy is doing well. The stock market's up because they printed more dollars. It means absolutely nothing. It's actually a bad sign. If you take the stock market, and there's some trippy graphs I can show you, and you invert the stock market into silver is a good one, oil is another good one, you'll actually see market crashes that happen that nobody knew about. So what I mean by that is if you took the S&P 500, which is measured by how many dollars per share, right? And instead you measured at how much oil per share, how much silver per share are those shares worth. The market crashed several times when everyone thought it was in a boom. Why? Because when you take a stable asset like gold, a stable asset like silver that's not manipulated, it's got that stability, and you measure the market in that asset rather than paper, which can be manipulated like crazy, you see the reality of what's actually happening. So when the market booms and you measure it in silver and it actually was a crash, that should be very concerning. Because the money is fluctuating. So you can just print more money and it looks like the market went up. But they can't print more silver. So you've got a stable asset. So I now look at how much, instead of dollars per share, how much silver per share, how much oil per share is the market actually worth. And it's not the same numbers. It's not the same value, and it's not the same trend. So that's what we're looking at. It's buy and hold. These are things that you're keeping. They're assets, just like your real estate would be, just like your sacred account would be. And the goal here is 5 to 10% of total net worth. Okay, 5 to 10% of total net worth in bullion. It's not a crazy amount. We're not saying sell everything and put it all in silver. We're saying 5 to 10% of your pie should be in bullion. 5 to 10%. Now, if that's concerning to you, it's because, and it's a sign, this is going to be kind of rude, it's a sign that you don't own any other assets. The only times people hear me say that and they're like, oh, I'm not going to do it, is because all of their money is in a 401k, all of their money is in the house. They have medium to minimal cash and nothing in real assets. They own no real estate. They've never owned a hard asset before. People are addicted to paper. So anytime I've had a client that when I say we need to buy bullion, they're like, oh, I'm not doing that. I'm not talking. It's because they've never owned anything other than paper. Even your house, you don't own. You own paper. It's a mortgage. You don't own a house. You own a mortgage. Until you pay it off, you don't own the house. You only own paper. Your car is the same way. You don't own the car. The bank does. You have the debt. Okay? So quit being addicted to paper. Buy real assets. You know?
When you get done paying the house, you really
Nope. Government does. So next thing we're going to hit here, we're jumping now into investments. So realize we're at the tail end of this. Now we're finally talking about investments. Okay, we talked first about making a decision for wealth. We talked next about making more money. Then we talked about gaining financial control, learning how to say no, stabilizing that increased income. And then we started diving into sacred accounts. We started diving into legal protection, credit, bullion, before we ever talked about investing. And I want to point that out on purpose. Most people are having the investing conversation way too early. You're not in a position to invest. If you're not making cash flow that could substantially tempt you to leave your job, you're not in a position to invest. So if I'm making $20 a month, just so I can say I'm an investor, I'm not an investor, I'm a dumbass. I should not be getting rid of that money yet. That's money that I need to grow before I've actually got enough to invest. So that money goes into my sacred account and it sits there and accumulates till I'm ready. And when I'm finally ready, the minimum, guys, the minimum, I'm not saying this is the number, I'm saying the minimum is 50 grand. So if I don't have at least 50 grand, I should not be looking at any deals. And even on 50 grand, at the most, you're going to make $300 to $500 a month. Okay, which means, let's say it is $500 a month. What's 50,000 divided by 500? What's that? Actually 12%, but 50,000 divided by $500. Okay, so it's going to take you 100 months to get your money back. That's a lot of months, guys. How many months? That's 8 years, 7 years?
100 divided by 24, that's, no, I'm sorry, by 12.
Yeah, I think that's 7 years.
8.3.
8.3 years. So if you take 50K and throw it into a deal that pays you $500 a month, you won't be profitable for 8.3 years. Meaning you won't make more than you put into the deal for 8 years. $500 a month, you're not rich. You're not wealthy. So even if you did 100, just double the math, it's still going to take you 4 years to break even. So the more money you can invest, the better off you're going to be. And so I'm not saying don't invest, because if you continue to snowball it and you know how to earn, then you can get rid of 50K every time and go make more. I've got a client that calls me every 2 or 3 months. He's like, hey, I got more money. Let's stick it somewhere. I got more money. I'm like, are you a drug dealer? How do you get money like this? But he sticks it every single time. He sticks it in a deal. And he's got these little flows that pay him every single month. And he knows he's not wealthy yet. He knows an investor is not anything to brag about. It doesn't mean anything. It's like a college degree. Until he's actually able to have his income cover his expenses, his 40% savings, and his taxes from all passive sources, he knows he's not wealthy. Okay, so we're going to talk about investing. The first level of investing is level 1 private placement investments. Okay, level 1. So a couple things you need to know. This is called a non-registered security. Typically, this is going to be registered under Regulation D of the Securities Exchange laws. And Regulation D means that it is not a publicly traded security. It's not something FINRA and the SEC registers for financial advisors to sell. Meaning this, if you go talk to your Ed Jones guy, he is not going to know what the hell you're talking about. Why? Because it's not something he's allowed to sell. If you go talk to your Merrill Lynch advisor, they will have no idea what you're talking about. They're trying to sell you an annuity. They're trying to sell you a mutual fund. They're trying to sell you an ETF. And you go talk to them about direct pass-through partnerships, they're going to be like, what kind of fund is that? Does it have guaranteed against loss and income for life? Like, they don't know any of that stuff. So level 1 private placements, it's a non-registered security. Examples of this can be merchant cash advances, land leases, private lending, real estate, DPPs, or direct pass-through partnerships. Those are all examples of types of private placement deals. Now, a common thread with these is typically they're backed by a real asset. Okay, so you've got something real there, and it's going to pay you an income every month. So it's not I buy a nothing and hope the nothing goes up in value. That's called stocks. Okay. I bought a nothing and I hope the nothing went up in value. Okay. Or, you know, I loaned money to buy a nothing, bonds, and I hope the nothing pays me every month and then I have a better face value when I sell it. So that's going to be, you know, market investing. If you look at real assets, these are mostly going to be in the private placement space. Unless you're doing it yourself, which I honestly don't recommend. If you're in the I've got 50 to 100 to $200,000 range, I would even say unless you're over $1 million in investable assets, the do-it-yourself method will only slow you down. You're going to get stuck in the mechanics of the deal. You're not going to do enough deals, and what's going to happen is you're going to end up just slowly making progress and plateau. And you're going to deal with property management, and you're going to deal with tenants, and you're going to deal with taxes, and you're going to deal with all the crap that if I'm a private placement investor, I don't have to deal with. That's why that's the only type of investing I will do right now. Okay, when I invest, it only goes into my sacred account, Bullion, and private placements, and it's mostly lending deals. Okay, so this is for qualified investors only. Now, this is interesting. The SEC does not actually give a definition of what qualified means. Okay, so the broker, what that means, the broker that's selling the investment or the issuer that's offering the investment, they're going to be the judge of what qualified means. For us, qualified means you have at least 50K. If you don't have 50K, we're not going to do a deal with you. Okay, so qualified is a very loose term. Sometimes that means 250 grand in net worth. Sometimes that can be income. Realize whoever's telling you that is just making it up because that's what they think it should be. Because the SEC doesn't tell you what a qualified investor is. They define it as somebody that has experience and can make a prudent decision on the investment and they're financially capable. That's about it. Okay, so that's qualified. Again, minimum is 50K. The goal here is to add passive income, not gain extra work. Okay, so this goes back to the do-it-yourself investor. That's a sweet fourplex, but you have a job that pays you $400 a month. That's what that comes down to. Okay, I don't have a job. My 50K is in a deal that pays me $350 or $400 a month. I don't have to do anything. Okay, we had a client actually right now where one of our deals didn't pan out the way that we said it would. It didn't actually play out the way we said it would. It was a certain term. And they said at the end of the term, we're going to give you your money back and you can be done and you're not having to renew. You can go do whatever you want to do. Okay, so think about, you've got 50 grand in a deal. It comes to term and the company says, hey, the money is still tied up in the deal. We can't get it out yet. If you're in stocks, what are you thinking, Nano? You're screwed. You're like, damn, I'm never going to get my money back. If you're in real estate, that would be the equivalent of you have this property you bought and your tenants stop paying you rent. I can't get money out of the deal. Okay, with our deal, because it was a lending contract, our contract stated if you don't pay us, we can either foreclose or we can charge you a higher interest rate. Our client's charging a higher interest rate. They went from a 9% rate to like, what is it, 18%? 18%. So imagine that, like talk about downside protection. The deal goes south and Nano doubles his money. Did it really go south? No, Nano's like, dude, yeah, I got double the rate of return now. And I'm still going to get my funds out, but go ahead and keep it a little bit longer than you said you needed to because I like this 18. That's what I'm thinking, okay? So that's a level 1 private placement. Again, you don't have to be accredited. You do need to be qualified. For us, that does mean 50K. Level 2 private placements. Okay, level 2 private placements. This is for accredited investors only. Accredited investors only. So this is also a non-registered security, meaning that it's not registered with the SEC as a security that's exchangeable in the public. You can't sell it on the secondary market, meaning that I couldn't buy a deal in the accredited space and then sell my deal to Nano. That's illegal. I would get in trouble. Okay, so if I buy it, it's mine, unless I sell it back to the issuer. Okay, so many of these options are going to be the same as what we talked about with the qualified investments, but the accredited investments are often stronger, meaning they're going to have obviously a bigger capital requirement, but usually a higher rate of return and better stability. Okay, and I say usually because that's not always the case. Sometimes with like hedge funds, for example, you have to be accredited there, but a hedge fund, you don't have security. That's day trading in the market again. So we're talking, real estate deals, oil deals, land deals, private lending deals, small business deals. Like these are real accredited deals that are backed by assets. They're going to offer a greater return to their accredited guys than they will to their non-accredited guys. The definition of accredited, just to clear this up for you, for an accredited investor, if you're measuring by net worth, an individual needs to be worth $1 million. Okay, excluding their primary residence. And this is the only reason we pick on homes, by the way. Own a home, awesome, do it, that's you, great. But if you come to us to invest and you're like, yo, I got my house, we can't count that. Legally, the SEC will not let us count the value of your home. You think it's worth something, and the bank thinks it's worth something, and your neighbors think it's worth something, and your realtor think it's worth something, but nobody else does. So the SEC, when you go to invest, they're not going to tell you your home is an asset. They're going to say, no, you live there, that's a liability. We will not let you include that in your net worth. You can't invest. I'm sorry. So that's the reason we pick on homes. It's $1 million of net worth, excluding your primary residence. You can also qualify by income. Okay, income, if you're a single person, your income has to be $200,000 per year in modified adjusted gross income for 2 years in a row. And I had a conversation with a client today about what that meant. He's like, all right, so if I make 200 grand, you know, and I do that for 2 years in a row, I'm good. And I was like, no, you have to make 200 grand after deductions before taxes. So if you make 200 grand and as a sole proprietor in your business, but it costs you half of that money to buy your goods and services, you didn't make 200 grand, you made 100 grand. The IRS is only going to let you count 100 grand. So the rule of thumb, if they didn't tax it, it doesn't count. So to make 200 grand, it has to be 200 grand in taxable income before the IRS will let you say, or before the SEC will let you become accredited. If you're a couple or a married couple, it is 300,000 by income. So 300 grand in modified adjusted gross income 2 years in a row. And that's basically where you're going to become accredited as a couple. All right. And so with that, like, you've really got to look at your options. If you're not a strong earner, but you're a strong investor, you're probably going to do that through net worth. I'm going to keep stacking my net worth because I only make 60 grand a year. And really, if you only make 60 grand a year, you should come work for us. But that's beside the point. Or I'm a really strong earner. Let's say I'm an ambassador with Wealth Dynamics. I'm killing it. I make 200 grand a year. I just have to sustain that for 24 months before I can invest in big boy deals. Okay. And I want to stress this, guys. With these private placement deals, I'm a broker for these. I literally cannot advertise them. Okay, I cannot give you any specifics about them. You can't hear about them. I can't give you details. I can tell you they exist. I can tell you there's such a thing, but notice I have never gone in depth with you on a private placement deal. I'm legally not allowed to. If I did, I can get fined and go to prison. That's how badly the SEC does not want you to know about them if you're not in a position to do them. If you're accredited, I can advertise to you about it all day. And I can say, this is for accredited investors only. You know, you're not accredited. I won't tell you about it, but Nano is, I will. So I want you to realize, like, in a very, very real sense, when it comes to investing, there is a curtain that's been closed on you and you're not allowed to know what's on the other side. And there is big money preventing it from happening. So unless you know a broker or an issuer, a broker is me, the guy selling the deal, or an issuer, which is the company that actually created the deal, unless you have a direct connection with one of those two parties, you will never hear about a private placement. Never. It's never going to be on a commercial. It's never going to be in the newspaper. It's never going to be on social media. It's not something you're going to hear about. So the importance of understanding that these exist so that you can get connected with the people that know about them, so that you're not investing in Wall Street where you are the investment and you can do these deals instead. That's really where you need to have your attention at. Okay. So again, that's going to be the deals. Now I'm going to end this thing off with running your wealth like a business. Okay. Running your wealth like a business. That's the last thing that we help our clients do. We help them establish foundation, get their production up, keep that production, put that into assets, protect it. Now we're looking at, we've got all this stuff going on. Let's organize it and run it like a business. Okay. So there's a couple things you got to think about. If it's a business, you actually have to think about it like a business owner. Okay, a good business owner is not the guy that makes $2 million a year in your city that can't wait to quit his business and sell it and retire. That's a quitter, not a business owner. Okay, a business owner is Sam Walton. A business owner is somebody that actually builds an empire and sticks with it. That's a business owner. Okay, other people, they might use their business, but it's not a business owner. And in my true definition, it's somebody that grows the business and sees it through the end. Not I just siphon income out of it, pay my employees as little as possible, do as little as possible and try and not have to do work. Like a real business owner, they look at their business like, this is mine. Okay, I'm passionate about it. Like Wealth Dynamics, I will never give up Wealth Dynamics. Does not matter how much money you offer me. I would never give my company up. It's my company. I built it. I'm going to continue growing it. We have awesome people and clients. That's the idea behind a business owner. And the reason I share that is your wealth should be that way. You should be that attached to your wealth. It shouldn't be this thing where you're like, hey, I want to stick it in an account and give it to an advisor, never look at it again, and I just draw money off of it. That's not an investor. That's not a wealthy person. Okay, that's an irresponsible sheep. That's what that is. Okay, so run your business like a business, run your wealth like a business. The first thing you need to do this is to know your goals and purposes. So if you don't know your goals and purposes, you're not going to keep pushing to build wealth. The reason why is you won't know why you're doing it. You won't have a motivation to do it. So you have to understand that it's not just retirement. Okay, do you guys want to know, like, in all honesty, as a wealth coach, when I sit down with a client, the client that I always know will lose and quit on their goals is the one that tells me they want to be wealthy and financially independent so that they can retire and not have to do anything. I already know that person is not, A, they're going to quit. They're not even going to make it. B, if they get there, they will hate the life they've created for themselves. They don't have a purpose. They don't have a goal. The guy that's like, dude, I want to build wealth because I have this passion and I want to start this business and give to these people and help these causes, that guy's going to get there, even if he's got less money than the first guy. Okay, so know your goals and purposes, just like in a business, right? Number 2, document successful and unsuccessful operating procedures. You're going to build your wealth over the long haul, which means you should have a portfolio that you pass along, and you should document how that portfolio works. Okay, writing down, what have I done that worked? How do I teach this to other people so that when let's say my trustee takes over, they understand the operating principles of this trust. They understand what's worked, what hasn't worked, and what I need to get rid of and what I shouldn't ever try, and the always and the never statements of this wealth portfolio. That's what you need to do next. Once you've got that, hire your family office. Okay, now this is an interesting concept. So back in the day, the term financial advisor did not actually come out till about the 1960s. Okay, before that, it was called a broker, and that only came out in 1933. So before 1933, there was no such thing as a broker, and there was no such thing as a financial advisor. Totally brand new concept, revolving around Wall Street, because think about it, it's a distribution force for Wall Street. So there was no such thing as a financial advisor. Wealthy people had what was called a family office. And this goes way, way back before the Rockefellers and the Carnegies, but Rockefeller was the one that popularized this concept of he would take all of his wealth and he would hire employees in-house to manage it. He didn't have a financial advisor. Rockefeller was the financial advisor. And he had employees, and the employees managed his estate for him. That's how wealthy people operate. So you will have employees. You will have executives. You will have staff. You will have people. You will create your own economy. That's why economy means to manage a household. It doesn't mean managing groceries in your budget. It literally means you have an empire and you manage it. Okay, when I say empire, I don't mean greedy, rich, everything is about money. I'm saying like whether you know it or not, you're creating one. It can be mediocre or it can be great, but you are creating one right now. And I'm saying your empire should fund your lifestyle the way that you want it to, and it should be inclusive of helping other people by allowing them to work for you. Like imagine like most people hate their jobs, A, because there's no purpose, and B, because their boss sucks and they're always stressed out, and C, because they're financially illiterate. So imagine if your job was to work for a company that was really just a wealth portfolio that had the purpose of the owner. The owner's like, hey, we're going to change the world with this. This is my legacy we're building. Like you could get behind this, right? Now, the second thing, your boss would never be stressed out because he didn't have a job. He was wealthy. He was financially independent. You would never have a stressed out boss. And C, you would never be financially illiterate because your job would be to manage wealth. As a byproduct of doing your job, you would understand money. That's the perfect job. If I had to pick a job, that would be it. Okay, so think about if you're the wealth, like the owner of the wealth, that's what you're creating for somebody else. That's the opportunity. When you think about, I don't want to hire people and I don't want to deal with that, it's too much work, you're being selfish. Okay, think about the opportunity you could give somebody to work for Carnegie, to work for Rockefeller, to work for these people, to work for you. Okay, so that's going to be the family office concept. Next thing is you need to have an organizing board. We have one for our company. You will have departments and divisions. If you have people, you need to keep them organized. We help our clients do that. It's an integral part of actually running a wealthy business or wealthy portfolio. Okay, so having that organized and then writing up descriptions of how things are done. Like, it's a new concept, but there's a job description to pulling money out of your sacred account. If you don't write up the post and write up how to do it, nobody's going to know how to do it. So if I hire Billy and I'm like, Billy, I need you to manage my sacred account, and I don't give him a description of how to do it, Billy's going to have a bunch of screw ups. He's going to get fired. It'll actually be my fault because I didn't teach him how. Okay. And then the last thing here is you need to track all of your decisions by stats. Okay. Track all of your decisions by stats, meaning I've got stats on asset values. I've got stats on income. I've got stats on cash flow. I've got stats on expenses, all only for my wealth. It's all for my wealth. And anytime I make a decision, it's based on my stats. I look at if the graph for my income went up, how do I handle that? What should I do? Should I reinvest? Should I cut expenses? Should I try and push the income up higher? How do I do that? And how do I communicate that to my employee? Because I'm not the one doing it, they are. I hired them to do it. And how do I make sure they know how to do it? Because I wrote up a job description. And how do I make sure they stay within the way I would have done it? Because I created policies and procedures. That's running your wealth like a business. And I don't care who your advisor is. Nobody teaches that but us. You can work for the greatest financial advisor in the world. And again, realize their job has only existed since like 1967. They will not do that for you. They will sell you a portfolio. They will send you a statement once a year, and they will charge you 1.25% of your assets to read you what your statement says. Okay. So that they're going to make money whether you do or not. So that's what we're covering tonight, guys. That's the Wealth Dynamics Blueprint. This has been part 2. Thank you for watching. Make sure that you like, share, subscribe. Check our video out next week, and I will talk to you guys soon. And by the way, go to sacredaccount.com if you'd like to learn more about Course Tonight.